What are bonds? How do they work? And all other questions related to this topic will be explained in this video. A bond represents a loan made by an investor to a borrower, typically a corporate or governmental. So they are a fixed interest security, which is one of the three main asset classes, besides stocks and cash equivalents like market funds. This means a security that pays a fixed rate for interest at regular intervals. However, this is not always entirely true. For example, there are also variable rate bonds that are linked to inflation and thus do not have a fixed interest rate. Bonds serve as a method for financing for governments or companies' operations. They are then called either government bonds or corporate bonds. For example, the government bond in the US is called a treasury bond. The same applies to companies. Like if a company wants to construct a new factory, it needs money. To get this capital, there are basically two options. Either the company issues new shares and thus takes new shareholders into the company, or it issues bonds on the capital market. The company receives money for these bonds, which it then repays at the end of the term. During this term, the company has to pay interest, just as with a normal bank loan. So let's take a closer look at how bonds are issued. Basically, a bond always consists of three components. One is the face value, also called par value, one is the coupon rate, and one is the maturity date. The face value of the investment is the amount of money the investor lends to the state or company. For example, if the price is $100, the investor lends $100 to the state or company, which is then paid back at the end of the term. If the investor wants to invest more than 100, he has to buy several $100 bonds. Now we come to the second element, the coupon rate. The coupon rate is the interest rate at which the government or the company borrows money and then pays out annually to the investor. Usually this is annually, only by the US bonds it is quarterly, but then also only a quarter of the interest rate. Let's assume for our example that the coupon rate is 3% per year and the term is 5 years. Our bond pays us $3 per face value of $100 every year for 5 years. At the end of the term, in this case at the end of the 5 years, we get the $100 face value paid back again. That means we get $3 interest plus $100 par value repayment. So the payout is $103. The third element of a bond is the maturity date. Usually it is somewhere between 3 and 7 years, but it can also go much longer. Some government bonds have maturities that are over 30 years. However, that doesn't mean they have to wait 30 years for your money. Bonds, just like stocks, are traded on a stock market. This means that you can also buy or sell bonds on the stock exchange during their term. For this reason, a bond, just like a stock, also has a price. However, it is not measured in dollars as with shares, but rather in percentages. If a bond is at 100%, it means you have to pay 100% to get back 100% par value at the end. So we pay $100 for our bond and get $100 par value back at the end. If the price is a little lower in the meantime, for example at 95%, we only have to pay $95 to have $100 of the par value. So we buy the bond at a lower price. Now you see that with a bond you can gain money in two different ways. Firstly with interest payments and then with potential price gains. Let's now look at why some bonds have higher interest rates than others. In this table you can see the interest rates of the listed government bonds. Here you can see that Swiss and Japanese government bonds pay significantly lower interest rates to the investors than for example Mexico, which is now at nearly 10%. The US pays an interest rate of 3.7%. This means that investors get significantly less interest for Swiss and Japanese government bonds, and so these countries also have to pay less interest. The decisive factor for these differences is the so-called credit rating, which is similar to your credit score. The largest rating agencies that produce these credit ratings are Standard & Poor's, Fitch, and Moody's. These agencies assess the probability that the country or company being rated will go bankrupt and thus no longer be able to repay its bonds, or only be able to repay them in part. For example, Greece nearly went bankrupt some years ago. Now significantly higher interest rates have to be paid for Greek bonds today because of a higher risk assessment. This risk is also expressed in the credit rating. Switzerland, for example, has the best rating with AAA, while the US has an AA+ rating. Corporates cannot achieve a AAA rating because they are generally more vulnerable than countries and therefore carry a higher risk. Although there is the possibility to speculate with bonds, they are in general a less risky investment than equities. Therefore, bonds are very suitable for minimizing risk in portfolios. If you have any questions, post it to us in the comments. If this is your first time on our channel, we'd love for you to subscribe. We regularly produce videos and tutorials on financial products, investment and investment strategies in order to make the world of finance more understandable. Subscribe to us to stay up to date.